Hey, everybody. Welcome back to another episode of Dad's Gone Crypto. A friend in our Telegram chat just recently asked if we could do an episode on how to take profits. Well, it feels like the crypto market is nearly ready to start heating up, so I think this is the perfect time to talk about setting up some profit-taking strategies. We'll cover a few methods that I like to use, and we'll also cover a crucial topic that should be relevant once the bull market really picks up, and that is how to take profits from pre-sale distributions in an ethical manner that doesn't kill, a newly launched project's chart. Before we get going though, I need to add a disclaimer, and that is that this is in absolutely no way financial advice. I'm just going to lay out some ideas that you should research fully before even considering putting them into action. Remember, I'm not a financial advisor. I'm just some crazy old dad that likes to bore my family with crypto talk. So, anyway, let's jump into it. Now, taking profits might seem straightforward, just sell when you're in the green, right? But as anyone who's traded in the volatile crypto market knows, it's not always that simple. You've got to balance greed and fear. And having a solid strategy that takes human emotions out of the equation can make all the difference in the world. So today, I'm going to walk you through some of my favorite approaches to locking in those gains. First, let's talk about target profit levels. Now, this is one of the most common strategies that everybody uses. Before you take a trade, you set a target price at which you're going to sell a portion or all of your holdings. The key here is discipline. Let's say you've bought Bitcoin at $60,000, right? And you decide that you're going to want to take some profits at $80,000 and then at $100,000, let's say. Well, by setting these targets, you avoid the emotional roller coaster of, trying to time the market perfectly. So once your price hits one of those targets, you sell a predetermined portion of your holdings, regardless of what you think the market's going to do next. Again, most simple way you can do it. Hey, I'm going to sell 20% of my holdings when Bitcoin hits 80 grand. I'm going to sell, 30% when it hits 100 grand. You set those profit levels and actually take them. No emotion. Very simple. But what if the market is rallying, right? And it seems like the sky's the limit. This is where a trailing stop loss can come in handy. Let's dive deeper into how this powerful tool works and why it's a favorite among seasoned traders. A trailing stop loss is a type of stop loss order that adjusts itself as the price of an asset moves in your favor. Unlike a traditional stop loss, which is, set at a fixed price below your purchase price, a trailing stop loss moves up along with the market price, maintaining a predefined distance from the current price. This way, you can lock in profits as the price rises while still allowing your position to grow if the market continues to trend upwards. So here's a practical example. Let's say you bought Bitcoin at the $60,000 mark, right? And your first take profit is about to get hit at that 80,000 we were talking about before. But you feel like the market might just keep right on moving up, right? Well, you can set a trailing stop loss at a certain interval below the market price. So just for argument's sake, let's say you set it at 10%. Now you're at 80,000. You set a trailing stop loss at 72,000, 10% below the current price, right? If Bitcoin's price increases to 90,000, your trailing stop loss automatically moves up to 81,000, which is 10% below the highest price it reached. Now, if the market suddenly reverses and Bitcoin drops down to 81,000, your stop loss will trigger. It sells your Bitcoin at that 81,000 because it's 10% below that high mark, right? Now, that ensures that you've locked in 21,000 profit per Bitcoin without having to sit and watch the market constantly. What makes the trailing stop loss particularly effective is its flexibility. It allows you to participate in the market's upside potential without constantly worrying about, when to take profits. However, it's important to choose the right trailing percentage. If you set the percentage too tight, let's say 2%, you might get stopped out just during, Bitcoin's normal market fluctuations or whatever asset you're trading. You'd miss out on all the potential gains. On the other hand, if you set it too wide, like let's say 20%, well, then you risk giving back a whole big significant portion of your profits if the market turns against you. So, there's kind of that fine line. And with experience, you kind of learn to set those in the right place. One approach to finding the right trailing percentage is to consider the asset's volatility. For high volatile assets, a wider trailing stop, 10, 15% might be appropriate. For less volatile assets, a tighter stop around 5 to 7% could work better. Most active traders also adjust their trailing stops dynamically based on market conditions, tightening them as the price reaches new highs to lock in more profits, or loosening them depending on what the market's doing. That's a good approach to just stay dynamic. If you're staying involved with your trades, it can make that trailing stop a whole lot more effective. Now, if setting trailing stops is just a little more complicated than you want to get, or maybe you're not trading on an exchange that offers them, a super easy method of taking profits is dollar cost averaging out. I'm sure you've heard of dollar cost averaging as a way to buy into a position gradually, but you can also use it as a way to exit a position. Instead of trying to time the top, you sell portions of your holdings at regular intervals, regardless of the price. For instance, you might decide to sell 10% of your Ethereum every week or every 3 days or whatever over, let's say, a 10-week period, right? That approach can help you take all the emotion out of profit taking and avoid the stress of selling too early or too late. It's just a really methodical approach that really helps take all the emotion out of it, which can be a really good thing. Switching gears to a more active approach, let's talk about rebalancing your portfolio in a bull market. Now, this strategy is crucial for managing risk and ensuring that you're not overly exposed to any one asset, especially as the market heats up here. In a crypto bull market, prices can rise rapidly, and it's easy to get caught up in the excitement. However, as your assets appreciate, your portfolio might become unbalanced. For example, if you started with a portfolio of, let's say, 50% Bitcoin and 50% altcoins, and altcoins experience a massive rally, well, you might find that now your portfolio consists of 70% altcoins and only 30% Bitcoin. Now, while it might be tempting to ride that altcoin wave, this also increases your risk if the altcoin market, were to suddenly turn bearish. So, how do you rebalance? Well, the first step is to determine, your target asset allocation based on your risk tolerance and your investment goals. If your original plan was to keep 50-50 split between Bitcoin and altcoins, you'll need to sell some of your altcoins and either reinvest in Bitcoin or move those profits into more stable assets like cash or stable coins. Rebalancing isn't just about restoring your portfolio to its original allocation. It's also an opportunity to take profits during this upcoming bull market here. By selling high performing assets, you lock in gains and reduce your exposure to the market volatility. It's especially important in crypto where bull markets can go flying, you're riding that high, and then bam, massive corrections. Now, a practical way to approach rebalancing is to set predetermined thresholds. For example, you might decide that if any asset in your portfolio exceeds 60% of your total portfolio value, you'll sell enough of it to bring it back down to your target allocation. Now, that ensures that you're constantly taking profits and not letting any single asset dominate your portfolio. Another consideration during a bull market is to diversify within your portfolio. So if your altcoin holdings have grown significantly, consider reallocating some of those profits into new promising projects that haven't yet rallied. This allows you to spread your risk across a broader range of assets while still participating in potential future gains. Finally, rebalancing isn't just about what you sell. It's also about what you buy. During a bull market, some assets might underperform compared to others. There are constant narrative shifts in the crypto market. Meme coins might be running like crazy while utility coins are just sitting stagnant. Maybe it's AI time and all the AI tokens are running, but the gaming narrative hasn't gotten hot yet. So you move some of those AI profits to the gaming sector, right? Rebalancing gives you the chance to buy more of these undervalued assets at a lower price, positioning yourself for gains when the market shifts to that, particular narrative. Now, let's talk about another slightly more technical, effective strategy for taking profits, and that is using support and resistance levels on a chart. Now, these levels are crucial tools in technical analysis and can provide valuable insights into when to enter and exit trades. So I'm sure most of you know this, but for those that don't, support and resistance levels are price points on a chart where the asset has historically had trouble falling below or rising above. So support is where the price tends to stop falling and starts to rise again, while resistance is where the price tends to stop rising and starts to fall. These levels can act like invisible barriers for price movements, and savvy traders often use them to their advantage. To take profits using these levels, you need to identify where they are on your chart. For example, if you're trading Ethereum and notice that it's bounced off of the 2,500 level several times in the past, right? That 2,500 becomes a significant support level. If it has struggled to break above $4,000, that level acts as resistance. So once you've identified these key levels, you can use them to guide your profit-taking strategy. One approach is to sell a portion of your holdings when the price approaches a known resistance level. So the idea here is that the resistance level could act as a ceiling, right? Preventing the price from rising further. By taking profits near resistance, you lock in gains before a potential pullback. So let's say you bought Ethereum at $3,000, for instance, and now it's approaching a strong resistance level at 4,000. You could decide to sell 50% of your holdings, let's say, at $3,950, just below that major resistance level. That ensures that you capture profits without waiting for the perfect exit and the exact resistance point. This strategy helps you avoid the risk of price reversing before you've had a chance to sell. Now, on the flip side of that, if the price is approaching a strong support level after a rally, you might hold off on taking profits, anticipating that the support will hold and the price will bounce back. However, if the price breaks below that support level, it could be a signal to exit your position or at least to set a stop loss because the asset might be heading lower if it's broken below those, major support levels. Another slightly more advanced strategy is to use a combination of support and resistance with other technical indicators like moving averages or relative strength index, for instance. For example, if the price is near a resistance level and the RSI is indicating that the asset is overbought, it might be a strong signal to take profits. Conversely, if the price is near a support level and the RSI shows that the asset's oversold, you might consider holding or, even buying more there. With any of this, timing is everything, right? So using support and resistance levels can give you that extra edge when deciding when to take profits. It's all about, stacking the odds in your favor and using historical price levels to help guide your decisions. Okay, now I want to dive into something that's been on the minds of a whole lot of people I talk to in crypto. This throughout the bear market and leading into this bull, a lot of people were investing in pre-sales. And, people have been asking, well, how do I take profits once these pre-sales start their distributions? For all of you out there that have participated in crypto pre-sales or ICOs, you know that these investments can offer incredible returns, sometimes even before the token hits the major exchanges. But how do you ensure you're maximizing your gains while minimizing risk and doing so in an ethical manner? So, first, it's important to understand that pre-sale distributions often come with vesting periods where your tokens are released gradually over time. One effective strategy is to sell the initial unlock. When your first tranche of tokens is unlocked, consider selling a portion, say 20, 30% immediately, or, just as it launches, as you get your tokens, sell them on those green candles as they're going up. That allows you to secure some profits, while still holding the majority of your tokens for future gains. However, it's crucial to avoid dumping large amounts of tokens on the market at once. That can lead to a sharp drop in price and hurt other investors and hurt the project, depending on how many tokens you've received in your pre-sale. To mitigate this, consider using a staggered selling strategy. So instead of selling all your unlocked tokens at once, break up your sales into smaller, more manageable chunks over a period of time. For example, you might sell a few percent of your tokens every few hours or days or weeks. This approach helps maintain market stability and reduces the impact on the price chart. By selling gradually, you're also giving the market time to absorb all that selling pressure, which can help prevent panic selling by all the other investors. One important rule is to sell on green candles. And what I mean by that is, when the price is going up, sure, go ahead, take some profits, sell some. But if the price is going down and you're it's in a slide, it's probably best to hold on to your tokens and wait for them to gain some value again before selling, just to, prevent that whole panic rush of a whole bunch of people trying to sell at once. Another ethical approach to taking profits on your pre-sales is to coordinate with the project team. Some projects offer guidance or even request that early investors follow a specific selling strategy to help maintain price stability. By working with the team, you can ensure that your profit-taking strategy aligns with the long-term goals of the project and the community. This collaboration can be particularly important in smaller and less liquid markets where large sales can have a way more significant impact. It's also wise to monitor market conditions before selling. If the market is experiencing low liquidity or heightened volatility, it might be better to hold off on selling until the conditions stabilize. It not only helps protect your profits, but also prevents contributing to further market instability of that particular token. Lastly, consider giving back to the community. If you've made a significant profit from this pre-sale, one way to contribute positively is by reinvesting a portion of your profits back into the project or its ecosystem. This could be through participating in governance, providing liquidity, even supporting community initiatives. By doing so, you're helping to strengthen the project and its long-term viability, which can ultimately benefit you and all of the project's investors. Taking profits from pre-sale distributions in an ethical manner is about more than just protecting your gains. It's about contributing to the health and longevity of a project and its community. By selling gradually, coordinating with the project team, and reinvesting in the ecosystem, you can take profits while still supporting that project's growth. So to wrap things up, here are the key points. Set clear target profit levels before entering a trade. Consider using a trailing stop loss to lock in your gains as the market moves in your favor, or use dollar cost averaging out if you're unsure about timing. Rebalance your portfolio to manage risk, and when taking profits from pre-sale distributions, do so in a way that supports the market stability and long-term success of the project. Remember, guys, crypto trading is a marathon, not a sprint. So having a strategy for taking profits can help you stay in the game longer. Well, that's it for today. Thanks for tuning in, guys. I hope you found these strategies helpful, and I encourage you to research and find what works best for you and your trading style. If you enjoyed this episode, don't forget to subscribe, leave a comment, and share it with your friends. Till next time, happy trading. See you guys. The material and information presented in this recording are for entertainment purposes only. Do not misconstrue what you hear as investment or trading advice. Always do your own research. The views, thoughts, and opinions expressed by the guests on this recording are their own and do not necessarily reflect those of Dad's Gone Crypto or its hosts.